Welcome back, everyone. Today, I want to take a look at a new buy I just made, and I only hold about 14 companies. So, if I hold the company that I'm in my portfolio, it means I'm very bullish on the company long term. And in my channel, I track my portfolio every week, fully transparent what I own. I want to talk about this new company I owned. I also want to talk about today's video of why when ASML dipped, I bought more of it. I want to talk about ASML as a company more because it's such a strong company that in the long term investing, I believe it could compound my wealth over time. And based on my investment philosophy, I'm going to keep adding more ASML. And the another thing I want to talk about in today's video is Bill Ackman bought $2 billion worth of Uber. And this is a company that I was kind of thinking about buying myself. Even before this, I've been looking at this company more. So I want to talk about Uber and discuss my long-term outlook on that company. And I just want to discuss that long-term outlook of my portfolio here and my plans and my philosophy when it comes to investing. So I have a lot to get in, so let's go ahead and get started. If you're new here, I'm all about finding companies that can compound over time. I'm talking 10, 20, 30 years. I'm looking for companies with strong fundamentals, real moats, and the ability to grow consistency. Now, I want to dive into why I just bought this new company of mine, which I'll pull up right here. It's in the consumer section, and it's actually Garmin, which I'm wearing right now, funny enough. Now, I want to dive into why Garmin fits this profile perfectly. Now, there's been a fitness revolution going on, and I think Garmin is perfectly positioned for it. I love when a company isn't just running a trend, but actually has a moat that gets stronger as the trend grows. That's exactly what's happening. First, let's think about what's really going on in the fitness right now. If you look around, you're seeing two types of people: the casual fitness person who just wants to count their steps and maybe track a workout here and there. That's your Apple Watch customer. But then there's this growing group of serious fitness people. I'm talking about people training for marathons, triathlons, serious cyclists, hikers, people who aren't just exercising, they're making it a lifestyle. And here's what's really interesting about Garmin's position. They've built this incredible ecosystem for these serious users. Let me show you what I mean. When someone buys a Garmin watch, they're not just buying a device, they're buying into a whole system of advanced training metrics, you actually align with the device itself. And the battery life can last lot longer. So if you're running like a marathon or like a trip, integration with all the apps and Garmin's ecosystem, which I'm going to talk about later, this ecosystem they're building out, which you see in things like Google and Microsoft, kind of similar. So I want to talk about that. And most importantly, they're getting specialized features for their specific sport. And what's really interesting from this investment standpoint is if someone buys a Garmin for a specific sport, whether it's running, cycling, or whatever, they start logging all this data in Garmin's ecosystem: their routes, their performance metrics, their progress, everything. And that's where it becomes more valuable. It becomes to them. That's a classic moat right there. But what has me excited about Garmin isn't just about this moat. If we look at their earnings here, which I'll pull up right here, they're actually up 31% in their fitness industry to 464 million revenue. But if we just pull up the revenue chart right here and go 10 years, they're growing their revenue on average for the last 5 years 10%. And this year they're estimated over 7 billion, which is up here. And then next year it's going to be closer to 8 billion. So their top line is expected to keep growing. And they already have like the number two share. And I like companies that can have a moat. And I like the fact how they keep growing. And I think where most investors are missing is Garmin has room to expand into software services just like Apple has done. Think about it. They've already have this valuable fitness data. They have a loyal customer base who's serious about their sports, and they have technical capability. The potential for high margin subscription services is pretty big here for Garmin, and it is definitely something I want to see them get into because recurring revenue creates operating leverage, and operating leverage is essentially what we want, right? So overall, I think Garmin is pretty good. And if we look at the market dynamics, while everyone's focused on Apple or Samsung in the general smartwatch category, Garmin has been quietly dominating these specialized fitness segments. They're not trying to compete with Apple Watch directly, they're just focusing on these specific user groups who need more than what a basic smartwatch can offer. So, just to I put in about $300. It's only about 3% of my portfolio. But the beauty of the strategy and Garmin strategy in general is that when these customers are also less price sensitive, when someone's training for a marathon or spending thousands on a bike, they're not going to think twice about spending a bit more for a device that actually meets their needs. That's why Garmin can maintain those healthy margins. And what really makes me excited for the long term investment in Garmin is the fitness trend, and it's not slowing down. People are becoming more health conscious, more interested in outdoor activities, and more serious about their training. And as this trend continues, Garmin's moat just keeps getting stronger. Now, I want to dive into what makes Garmin special, because this is interesting. And if you're new here, a moat is basically something that keeps a company ahead of its competition. Think of it like a castle. The harder it is for competitors to get in, the better. And looking at my portfolio, I've got, you know, Amazon, Microsoft, all these tech companies, but Garmin's got something really unique going on. And if we look at the revenue, like I said, their revenue is growing year over year. Also, if we look at their gross margin, they have a gross margin of 60%, which for comparison, most hardware companies are lucky to get 30 to 40%. Apple, which everyone thinks of as a credible business, and I own some of Apple too, they have about 45% margin. So Garmin's actually beating them. And if we check this out right here, they have so much more cash than debt. They have $2.4 billion in cash and only $100 million in debt, which gives them a lot of room to invest in new products, expand into new markets, weather and economic storms, and return to shareholders through dividends and buybacks. And they have been growing their dividend over time. They haven't really been buying back shares, which I would like to see them do in the future, but it's been flat. They haven't been diluting the shareholder, which is good. And overall, I think Garmin is just a really nice company with the strong fundamentals for them to expand even more. And I'm excited to hold them, and I'll continue to monitor them. They usually beat their earnings, which is a good sign. And I'm going to keep tracking them in my portfolio. Like I said, I only hold about 14 companies. So if I'm holding a company, it means I really believe in them for the long term, where they can keep growing, compounding my wealth over time. I want to talk about Garmin's forward PE ratio and their valuation. PE just stands for price to earnings, the multiple you're paying to buy the company. And their forward PE is around 27. And that may seem kind of expensive, but if we've looked at companies like Microsoft or Amazon in my portfolio, you got to look at their price too and their PE. And if you missed out on them, you would have been missing out on gains. So I think a PE ratio is something important to look at, but it shouldn't be like the number one thing. So with Garmin, you're essentially getting a company with no debt, right? Operating margins above 20%, which is really good, and steady revenue growth and tons of cash to keep in the growth. And with operating leverage, there's this thing that really starts kicking in because they've already built their software platforms and infrastructure. A lot of their new sales can drop straight to the bottom line. And that's exactly what you see for long term compounding, which is nice for Garmin. Moving on, I want to talk about a company that's in my tech sector here. I've been adding to this company, and it now makes up about 7% of my portfolio, and that's ASML. ASML is an interesting company, and I just want to dive deeper into why I really like ASML. So ASML basically supplies these lithography, I don't even know if I'm saying that right, but like these machines, and they sell them. They're super, super advanced, and they have like deep ultraviolet machines to semiconductor manufacturers. And we know the demand for semiconductors are huge right now because that's what powers AI. And approximately 30% of ASML's revenue comes from reoccurring service contracts. So this is just basically once they give a company the machine, which they have moat, and I'll talk about that soon. But once they give the company a machine, they have to maintain this machine, and 30% of the revenue just comes from ASML maintaining it because they're the only ones who know how to do it. And they have like these advanced semiconductor chip machines, and it gives ASML significant pricing power because of their moat, which I'm going to touch on here pretty soon. And they work with companies like TSMC, Intel, Samsung. Heck, I think they work with, like Tesla, Nvidia, because they supply the machines. These other companies are what's making the actual chips, design the chips, but they need the machinery to do it. And that's what ASML is doing with their business. Just to give you a picture of just how incredible this is, ASML, their etching patterns, which is the patterns you put on these little teeny tiny chips, can go as small as 8 nanometers, which to put that in perspective, a human hair is approximately 80,000 nanometers. That's just insane to me. And ASML outsources about 9% of its components to specialized suppliers, which gives them another competitive advantage. And they have over 7,000 active patents. 7,000. So these engineers have developed something incredible, and they have a global market share of 90% in this equipment. That's huge, and we're going to talk about risk later on with this company, but right now it just looks like a great company to be in, and they're definitely below fair value. In fact, if we go to Morningstar, they say they're trading at 17% discount, but basically one bear outlook for them is they fail to innovate. I guess China could maybe come up with a cheaper solution these companies will jump to, but I feel like ASML has already entrenched themselves in these companies, and we're going to look more into the fundamentals here. And it's just such an interesting company to me to invest in the long term because 20, 30 years down the line, for me compounding my wealth, I think it's very, very interesting. ASML also has a long term focus. They think like 15, 20 years down the line. They're always thinking ahead, always thinking about earnings, and it's definitely an easy company to follow. And once you understand the company, it's just so easy to understand and follow. And that's the type of company you want to invest in. You want to invest in companies that are predictable, have good pricing power, and have a moat. And ASML definitely shares all that. So it's something I'm definitely excited in. And like I said, they have a global presence. And I bought more of it after it dipped through this DeepSeek news because DeepSeek's just going to cause more demand for AI and more demand for this machinery. Therefore, you have ASML. So I don't really understand why it dipped. It was just a buying opportunity, and I really like the company, so I'm buying more. Now let's go ahead and look at ASML's numbers here. Right now, as of the time of recording, they're trading at $725, and their stock has been very volatile lately. But if we look at their valuation, they have PE ratio of the trailing 12 months 36, but their forward PE ratio, which looks at their next 12 months, or their 2026, which is the analysis predictions for the next into 2026, is 24. So it is cheaper in the long term. Their price of sales 9. So I think the valuation of this company is decent. They have a free cash flow yield of 3.2%, which is just the free cash flow per share divided by their current price, just the free cash flow. And 3% is pretty standard, so like usually like below 1% expensive companies. So this is pretty standard right here and is interesting. They have an operating margin of 31%, which is incredible. That's really good. They do pay a very small dividend, but if they grow the dividend over time, your yield on cost is going to go up over time. And two ways companies can help the investor out is increasing their dividend and share buybacks, and they have doing that. I would like to expand this a little more, but overall, they're looking really good. And if we look at the free cash flow showing 12 months, you can see here that it just spiked up recently to $9 billion. And you can see their bookings right here, which is just essentially the companies are working with to supply these machines. And this is a key metric just to look at. And you can see it's just been steady. It's going to keep growing. And just as long as ASML holds its moat, which they should, it's going to be just a great company to stay invested in. Moving on, we have this news that Bill Ackman bought $2 billion worth of Uber. And before even this news broke out, I was actually thinking of buying Uber, which is interesting because, like I said, I don't buy a company unless I really, really like the company because I invest 10, 20, 30 years. Companies I want to hold for the long term. Like the average investor only holds a company for 10 months. And fundamentally, I feel like that's wrong. If you're going to invest in the company, you should be investing in it for the long term because why even invest in it in the first place? And that's how you're going to outperform the market, in my opinion, over time. And Uber is definitely one company that I've been thinking about investing in. And I just want to dive deeper into Uber here. So Uber's three business segments really rely on mobility, which is just sharing rides, right? And then delivery, which is like Uber Eats, which kind of competes with DoorDash. And then there's just like delivery and kind of sell like packages. And if we look here, Uber has 160 million active users. And this is going to become very important, in my opinion, when we look at the competitors and kind of like comparing them to like Tesla or was owned by Google. Just these self-driving cars. And Tesla is a very expensive stock to buy right now. Uber, not so expensive. But Uber has this active user, like a base, and it's going to be important later on that I'm going to talk about. And they dominate the riding haul market with a 6% market share, which is incredible. And if we look at their what they're spending on their R&D, they're looking into like the auto vehicle technology, similar like Tesla, like AI driven automation and electric vehicle integration, which if that's where we're heading, that's gonna be a really nice investment. And people who are betting on Tesla, like I said, this company is trading at a lot better valuation right now than Tesla is. But I want to talk about the partnerships here pretty soon. So they're actively pursuing these partnerships, right? They're partnership with Waymo to bring autonomous vehicles to Austin, Atlanta in 2025, and strategic partnerships like Tesla and WeRide. That's going to be key to Uber because, like I said, they have this huge customer base, this moat, which I really like. And if they can partnership with these companies that actually build out the technology, it's going to help Uber in the long run. And it's definitely going to help them expand. And another thing I like about Uber is their membership program they launched because just like companies like Netflix, you want to see recurring revenue. I think I think recurring revenue is such an important thing for businesses because it creates operating leverage because businesses just need to build it out once as a fixed cost. And then as they expand their members and the recurring revenue, essentially their profit margins go up over time, which creates operating leverage. And that's exactly what we're seeing with Uber right here. They've grown their membership program to 30 million members, which is up 60% year over year. And they just have a large footprint. They have a 76% market share, like I said earlier. Lyft, which is the second one, only has a 29%. They have an asset light business, which is very good to see. You want to see businesses who are capital light. And like I said, and this is what makes Uber so interesting to me, is they're developing the autonomous vehicle technology, like Waymo and Tesla are developing that. They're doing like the hard work and spending a lot of money when it comes to developing this technology. And their valuations are higher than Uber, especially Tesla. But Uber has this user base. They have a platform. And if Tesla and Google, they know that. And if they partnership with Uber, there could be a lot of money to be made. Now, if we pull up Uber's numbers, they're trading at 74 because it spiked after Bill Ackman announced he bought $2 billion worth of it. But their trailing 12 months PE is 16. Their price to earnings, which that's still pretty cheap, and their forward PE is which is the next 12 months is 30, which is a little bit more expensive, but like big tech companies like Apple are trading higher than that. So it's not a horrible valuation. Their free cash flow is 3.28% adjusted for stock-based comp, which is interesting. And what makes Uber so interesting to me is not just their revenue growth, but their monthly active users here. They're growing this for the last 5 years, 10% year over year. Last 2 years, 15%. That's incredible because not many companies can sustain that, and they're just sustaining it all the way back, like literally since like 2019. And if they can keep growing this customer base, which I talked about earlier, it's gonna help Uber out in the long term. So this is an interesting company to me. And this company didn't even used to be profitable, right? They used to be in the negatives of their earnings, but they flipped that around and now they're actually earning money. Now there is one thing I don't like about Uber, which I am gonna touch on here pretty soon. Their trips, they had 11 billion trips in quarter four 2024. That's insane. There's no company that's even gonna come close to that. And look just how much it's growing over time. So it's definitely interesting. This chart definitely paints a picture for Uber. You can see in early 2020, they had negative free cash flow, but then they had like a change in leadership and a change in development of what the company wanted to do. And they started performing a profit around 2022. And now they're They have about $7 billion of cash flow, and it just keeps rising year over year. Now, obviously, the last 2 years, it's risen like 322%. That's probably not sustainable, but it's definitely exciting when it comes to this company. It's just such a company that I think more and more people are using, but the stock, a lot of people don't really think about the stock. They just think Uber in their everyday lives. And it's definitely interesting. Here's the one thing I don't like about Uber, and it's their shares outstanding. They've increased their shares outstanding for the last 5 years on average by 5%. Why do I not like that? Because essentially, when a company increases their shares outstanding, it dilutes the shareholder. So if you own shares of companies that are going to keep pumping out more shares, it's going to dilute your shares. Ideally, you want to see companies similar to Apple where they're buying back their shares at aggressive rates, which that turns their earnings per share higher over time, which is going to increase the stock. So if Uber's going to keep increasing their shares outstanding, that's not a good sign. But if they can reverse this and just make it flat at least, or start buying back their shares as they gain more free cash flow because now they're actually a profitable company, then it's going to be more sustainable and a better investment. When we look at my portfolio here, if I were to add Uber, I think it would go somewhere in the consumer category. I'd probably have to recategorize my stocks, but overall, my portfolio, I believe in it for the long 20, 30 years from now. I'm going to continue to hold all these companies, and yes, I might add Uber. I'll keep you updated if I do sell like a company to replace Uber in, because you really don't need much companies to become a successful investor. As a 19-year-old, I'm for the long term, and I'm going to keep holding companies that can compound my wealth over time. And if you're still watching this video, which, fortunately my viewers don't really have great retention, so it means a lot if you're still watching, just please hit the like button, comment down below, subscribe if you want to keep following because it helps my channel out. I'm a smaller YouTuber, but I'm going to keep pumping these videos out, really diving into companies that can build your wealth over time instead of these scammy get rich quick scheme stock market videos, and just my thoughts on the economy and the market overall. And I think that's going to be it for this video. I hope you enjoyed, and I'll see you in the next one.